Hello everyone. This video I'm recording specially for those who have just started their career and who are often burdened with the crowding effect or the word of mouth that is going on in the society. We get convinced easily, we believe all the myths without actually introspecting if the myths are actually correct or not. And I believe there are a lot of financial myths going on in the market, which I also was made aware of as and when I meet and interact with new people. So I just wanted to address those myths and actually bring in front a true picture. So I've listed down mainly 7 types of financial planning myths that I've heard from people in and around me, and I will be talking about each one of them one by one. So the first financial planning myth that I come to know about is that financial planning is only for rich people. So when I discuss about financial planning with a peer of mine or a junior, or let's say for example a friend or anybody who is not that well to do, a middle class person probably, or a lower middle class or an upper middle class, not rich category. So the first question or the first thing that they say is that I do not have so much cash at my disposal or so much amount at my disposal after my spendings. So I am not in a position to financially plan my money, and I can only barely survive with what I earn or the money that I get. And so if I would have been rich, if I would have had more money, I would have definitely financially plan things pretty well. So at that point of time, I do recall things and concepts that we learn how to financially plan things in a better way. So we have instruments in which even the per capita low income earners can invest their money. We have already heard of the concept called SIP, systematic investment plans, and you can start investing with as low as 500 rupees per month. And I think 500 rupees anybody can have at that their disposal. I do personally see a lot of people trying or overspending on things which are absolutely not essential, and not wanting to get a SIP done just because of the fact that they believe that they are not rich. So this is the first thing, that being rich is not the parameter to see if you can actually start financial planning. The only parameter that you have to start to introspect is whether you have funds that you are overspending, and whether you can allocate some portion of the limited funds into instruments which is going to help you in the appreciation of your capital and ultimately in financial planning. Next, coming to the second financial planning myth that I hear of is that financial planning is only restricted to retirement planning. So obviously we are working, we work till the end of our lives, those who are in employment, or let's say for example those who are in business. So we learn. I got to know that people do think of financial planning as retirement planning. That I am planning things in such a way that I'll retire by 40, I'll retire by 45, and I will not do anything post that. So my take, it's very subjective, but my personal take on this is that you you cannot actually predict when you are going to retire. Let's say for example, for some person it could be 45 years, it could be 50 years, it could be 60 years. Also, ideally you are going to spend a major portion of your life when your human capital element is more than the financial capital, which will be more when you retire. So ideally, when your human capital component is more, you have more money or you have more financial planning to do. You can't just wait for the retirement part, or you can't just put in your funds in PF, provident fund, or let's say for example another mutual fund or SIP, and just wait to withdraw it till the end of your retirement. That's very foolish and that's very bogus as per my belief. There are a lot of things. For example, there can be contingency requirements in the middle of your survival throughout your life, and you might have your life goals which you need to meet. So now for each goal, so we call this the concept of goal based investing. If you actually want to follow the concept of goal based investing, you cannot just believe that financial planning is restricted to retirement planning. So that would imply that your only goal in life is to retire well, and for the rest of your life you mismanage your money to the best extent possible, and you just wait for retirement and then you enjoy. I don't think that's something very practical. So what is required to be done is that it is a very spontaneous process, and you have to get involved into financial planning throughout your life, throughout the period that you start working, and not just till the retirement period, for the retirement period. Next, point number three, that we are too young to need a financial plan. I mean, it's never too late. There's a saying, right? That better late than never. But obviously, again, there are a few people who said never late is better. Okay. So the idea is that people do say that we are too young and we are too immature to handle money, to do our research. We are not that well aware of things. So ideally, if we see people, successful people, they start investing at an age as low as 14 or 15. I've seen people who have started investing at the age of 8 and 9 as well. So it's all about your mindset and the your willingness to get into things, to towards your goals, what you have said towards your life. And it is not like you cannot just say that you're too young to start investing, and when you start working, or you're just now in your college level, or you're just at your school level and you can't. I mean, we do get, if we are at a school levels, we do get pocket money. Or if some people do not get pocket money, they at least have some savings, or they get some money from home from their parents, if they even don't want to work on their own, which is highly recommended that you should start. You should not be dependent on anyone. You should have passive sources of income even when if you're in your school level. You have to find ways to generate that. Even if, let's say for example, hypothetically you don't have such a situation, what you're supposed to do is that whatever money that you're spending on outings with your friends, you have to limit those number of outings and start investing. I'm not saying that restrict your luxuries or do not do things that you want to do, but you have to strike a balance and you have to start investing, so that from the very beginning, your capital appreciation part would obviously be more if you start investing from a very young age. Now, that is a separate issue, how you make money or how you save. And I discussed about that. You need to have passive source of income, be it content writing, be you either you teach or you take an internship or whatever. That's completely subjective. But this is not very practical to say that it is too young for me to start investing. You can start as low as 500 rupees per month on SIP, as I mentioned. That is the most basic type of investment. I'm not saying that is the most exhaustive list of investments, but that is the most basic type of investment that we can get into. So ideally, age is not a factor to be considered while you financially plan things. This is the third point. The fourth point is financial planning is a one-time exercise. So ideally, let's say for example, your goal was to buy a car. Now I've bought a car. I needed 5 or 10 lakh rupees to buy a car. Let's say, for example, 5, 10 lakh rupees you needed, and you bought a car, and now you financially plan things pretty well till the time you bought the car. But oppose that, you're like, now I don't have any goals. Now let's, for example, that was a one-time exercise. Let's stop over here. Now I will spend like anything. Like I do not have any goals, so I will not start saving and everything. So that's how the mentality is for a lot of people. You may find that weird, but yes, there are people who actually think like that. So financial planning in this context could additionally what it could be, once you have bought a car, you have additionally other expenses like the petrol expenses, the parking expenses, the maintenance expenses. For example, there's some emergency, the car breaks down. I mean, there can be a lot of expenses. So how to manage those expenses could be the part of the additional financial planning that you can continue post buying a car. So of course, it is not a one-time exercise; it is a continuous exercise. And this was just an example of car. You can assume it in the case of a house. If you buy a house, I mean, for example, you financially plan things pretty well, and you have bought a house and everything. Now you think that it's enough. Now I'm not going to invest anything because I have achieved my goal. But the other goals could be, let's say, for example, paying taxes for your house. How to financially plan things so that you are not touching the other part of your income that you have devoted towards other areas of spending, and you actually plan things and invest things in such a manner that you generate, or financial, not just investing. I mean, financial planning is not just restricted to investing, which I will be touching upon on the next point. So I mean, you have to plan it in such a way that you can obviously additionally also you can meet your financial goals once you achieve your primary goal. So goal can never be exhausted. There will be other goals that will be keep on coming after that. So it is a very continuous process. What I'm trying to say, it's not a one-time exercise. Next, as I was mentioning, financial planning only means investing. So it's a big myth. When I talk to people, when I say you have to financially plan things pretty well, they mean I'm talking about investing. They would be like, no, mutual funds are risky, shares are risky, FDs give low return. I mean, a lot of things I personally hear. But the idea is financial planning is not only limited to investing. For example, I can just give you an example that I follow in my life daily. I know what are my spendings, like I what is my average spending. I calculate that, and I know towards what area I need to devote how much of my money. Leave apart the contingency requirements that could be come out of the box, and I was not prepared for that. So obviously you need to have an emergency fund for that. For 3 6 months of your income, you'll have to need to have a contingency fund. That is part of the financial planning process. So investing probably could. So what? Coming back to what I was saying, that what I personally follow is, let's say, for example, hypothetically, I know that I can only spend 10,000 after all my fixed expenses, be it my leisure expenses, be it other fixed liabilities that I have to pay, be it towards my groceries, be it towards something I need, and be it when I go for my outings. After that, I know 10,000 rupees I have spare, and I can devote it in these and these areas. For example, my conveyance expenses would be limited to 2,000 per month. So all this is also allocating things, how you're going to spend them is also part of the financial planning process. Even if you're not investing, which is highly not recommended, you should invest your money. This limit that you fix on yourself, that so that you do not overspend, is also a part of financial planning. You buy insurance. Insurance is also part of your financial planning, be it a life insurance, be it a term insurance, be a medical insurance. So all these things are part of financial planning, and it is not just investing that you're doing, but you're financially planning things so that the cash flow management is automatically done in a proper way, so that you do not, you are not getting shocks all of a sudden, and then you just think how to get hold of these funds and all of that, how to manage this, all the things that are coming out of the box. So financial planning is not only restricted to investing, it is how you manage your money in a proper way so that you can take care of everything, all elements. Next, a very common myth is, I already have a life insurance, I'm paying premium every month, and if, for example, if there's some unforeseen circumstance, I will get, my family or my dependents will get a huge money that I would already have left if I was not get doing life insurance. So life insurance premium is the only investment that I'm doing. The idea is, God forbid, if an unforeseen circumstance happens, you are not there to enjoy that money, right? Your family will definitely get it, but you are not being able to get the advantage of the financial planning that you are doing. It may be a psychological advantage that, yeah, my family will be safe. But ultimately, what is the objective of financial planning is to meet your and the stakeholders around you, meet all the objectives, and ensure a very a good ecosystem around financial planning. So life insurance is not going to suffice, because it will be after an unforeseen circumstances, maybe after your death, the benefit will be given to your stakeholders, but you are not the one who's enjoying it even after paying premium for so long. So ultimately, what you're supposed to do is that the whatever things you have planned throughout your life, you have to plan your premiums as well, LIC premiums as well, and you have to also manage it in such a way that you can also enjoy the money that you have invested or you have kept aside, or whatever way you have. Out of the or salary that you're getting, or out of the business revenue that you're generating, the profit part that you're generating, you are able to allocate to the areas that you have devoted for each expenditure type. So the whole idea is very this is what I actually come to know from people, that financial planning is this, financial planning is this, and it is not this. It is a more broader picture than actually you think. So that is why I felt the need of making this video, that to expand your thinking around this area of financial planning, and then you will be able to manage things in a better way. So this was about point number 6. Point number 7, a lot of people say that, who have intergenerational wealth, who are very rich, and they depend on that. They do not want to. Let's not go into that, but let's also try to touch on it, that a lot of people try to not work hard because they know that they have an inheritance that they're going to inherit after their family members pass it on to them, maybe after they die or whatever it is. You've already heard of the testamentary benefits and will part and all of that. But the idea is that you can't just depend on that. Firstly, because there are a lot of reasons why you should not depend on it. The first primary reason being that, for me, it is not a matter of pride. Firstly, for if somebody, it could be, no, it's a matter of pride for me. I don't care about it. Secondly, it could be like, there can be n number of reasons. Let's not go into it. It will be a big list. So the idea is, so let me also touch upon this fact, like how you can plan in the case of inheritance. So, for example, your father, this concept is prevalent a lot in the US and all. There is, so what happens is, for example, let's say in your family hierarchy, your grandfather is there, your father is there, and you are. So, your grandfather would be inheriting the property or whatever assets the person has to your father, and then it would be inherited by you. So, in most of the countries, there is an inheritance tax that is supposed to be paid. So, for example, when your grandfather your father inherits the property from your grandfather or your father, based upon the tax jurisdictions, would have to pay tax. And when you get inherited the same property, you will have to pay tax. So sometimes the grandfather and the person feels, the grandson feels or the father fee. I mean, in the family, this discussion is going on that we are paying double tax on the same amount of inheritance. So what should we be doing is, and I think what happens is, the grandfather will directly transfer the property in the name of grandson, and the father will be eliminated from the middle. So this is the kind of financial planning. It is not just restricted to the inheritance part, but it is a more broader picture if you talk about it in very legal and jurisdictional perspective. So I mean, that element can also, that concept is called generation tax, and or inheritance tax, as you may call it. And I mean, tax authorities are quite clever. So they saw that this practice was happening. So just for knowledge, I'm mentioning this. They imposed a few tax jurisdictions have imposed generation skipping tax. So let's say, for example, if we try to avoid double taxation by passing from the grandfather to the grandson directly, then there is a generation skipping tax, because you skipped a generation to transfer assets to avoid double taxation. So ultimately, the tax revenue goes to the government properly. So the financial planning is not just limited to inheriting assets and spending money when you are not in a position, you don't have ample assets of your own, you have not worked hard, you're just dependent on it. But this thought process also, you study a lot, you research how to plan things after you inherit as well. So it is, so what I'm trying, the crux of recording this video is that the concept of financial planning has to be looked upon on a more macro perspective than a micro perspective. And the common myths that we hear from a lot of people, they have to be kept aside. And actually, I mean, some myths can be true. As I mean, if it's true, then it's not a myth. But if you hear about something, try to research on it and try to identify, try to question, have the rational attitude as to understand how, if the person is telling me this, if the person is right or not. You need to consult few more people. You need to read. You need to read a lot to understand things. You can't just follow word of mouth. So I think these are the common financial myths which we should not blindly believe and have our own thinking. And I mean, this was, I believe, important to have communicated to all of you. So thank you very much for sticking to the end of the video. I hope the content was useful.